to buy or sell. There is definitely a few things that from this webinar that you can hopefully use to help you understand how do we make entries as traders, or how to even analyze charts, right? All right, so a few things about what CFD is first, right? Because I'm from the CFD department. All right, CFD is basically contract for differences, right? They are products that gives traders exposure to underlying assets without owning them, right? CFDs are traded on margin, and it gives us up to 20 times leverage, right? CFD allow us to trade in any directions of the market, in any environment, be it bullish or bearish, right? Over here at Phillip CFD, traders have access to over 5,000 products to trade with, right? Some key things is that most stocks or even ETFs, they tend to be a bit costly. So having that power of leverage or trading on margin allow us to use a small amount of capital to own them, not really owning them, but to purchase them and to experience that price change and to turn a profit from there, right? And it allows to short and long as well. Okay, here are some of the products that we offer. I mean, there's over 5,000, but these are the few things that we have. All right, Forex or FX, right? Main currency pairs, major pairs like USD yen or British pound with USD. All right, some indices we have Nikkei 225, yeah, Japan. All right, equities, the usuals, Amazon, Nvidia, Apple, and many more. Commodities as well, oil, gold, and silver. Right, ETFs, well, mostly with the QQQ, which is your Nasdaq 100, TQQQ, SQQQ, which is for the shorting of the Nasdaq 100, and now STI, which is Nikko M. Right. So some of the few things that when we take into account when it comes to trading is to understand price action analysis. Right. Most of the time when as traders, when we go into chart, when I first started, I really don't know what I was doing. And with from years of like practicing and understanding how to use price action analysis, looking at candlesticks, I've adapted a few one or more strategies that usually I use when it comes to stock market or even for FX, right? So I started with FX. So for me, I prefer to use practice my charting on FX as most of the charts are not gapped. I mean, there are situations where they are gapped, especially now, but compared to stock market, FX runs 24/5, right? So it's a bit easier for us as price action analysis to take charting and finding patterns and recognitions for trend line and everything, right? Compared to stock market. I'll have some few examples as well later for you to see why some stock markets is a bit harder to chart. Right? So first things first, all right, when we open up a chart, all right, most of the time when I started, it was just a green line. I don't know what's going on. So the key thing first is always to identify trend, right? What trend are we in? Knowing the market conditions, right? Trading, identifying trend, allow us to trade with trend, right? Trading against it is almost like swimming against the current, right? It's going to be very difficult. You're not going to be able to effectively trade, right? So the first things first, we can see here, right? It's our uptrend, right? So a simple way to identify uptrend is that, of course, the market is going upwards, right? And from there, a series of higher highs and higher lows, right? That defines a high uptrend. Okay, as we can see, our indicator of the arrows, the green one will signify the higher lows, and the red ones will be the higher highs. Right. So when we use charting price action analysis, we tend to use a lot of trend lines and basically using trend lines. See, most of this webinar will be using trend lines, right, to identify how we're going to trade. Right. So very simple using of lines to really find opportunities. Right. So from there, we have our downtrend. Right. So why did I draw a secondary trend line? Right, a trend line for a downtrend usually will be a connecting of the lower highs. All right, so that would usually signify a downtrend. As you can see from the red arrows indicated, right, that will tell us that it is a downtrend. All right, so why would I have a secondary line across? So one of the key things that we trade when using trend lines is that we tend to try to connect the lower highs or the higher lows, right? So that gives us a bit of a channel. So as you can see, price usually bounces off the trend lines, right? And that's where we can usually take short trades within this channel, right? And from there, we can see that it's quite effective. It's one of the things that I still apply to today when I do my chart analysis, right? These are actually charts that I personally took off from my trading view on poems to share with you all today, right? Next up, all right, we have pretty simple. All right, this is a ranging market. So basically, what it means is that price is going sideways. Buyers and sellers. All right, imagine what price action analysis. Price action analysis is basically is to understand buyers and sellers. It's like a war going on. So when it starts to range, that means that neither are having a edge against each other, and price is usually caught, right? From this point, we can see that it's kept between what we call a support and resistance line. And as price goes up higher, sellers push it back down. And as price goes down lower, buyers push it back up. Right? How we usually trade this is that we can still take trades in the ranging motion. Right? When it gets to the high and gets to the low, we can execute a sell or buy. Right? But most of the time, I will wait for what we call a breakout, which means that once either the buyers or sellers have won, then we will wait for entry from there. Right. So moving on. So some of the things that, as I mentioned, is how do we trade using just trend lines and understanding where trend is going. Basically, there are a few patterns that I learned when I first started trading because I feel that it was one of the easiest way to look at the market, right? To really to understand how price action works, right? To understand that price tend to move certain direction once it breaks out from the shape, right? So some of a few popular ones are your head and shoulders, all right? Your double tops or bottom, flags, triangles, and pennants, right? Right, so head and shoulders. So as you can see, this outline that I've drawn, right? Basically this is a perfect head and shoulder, right? But most of the time the markets don't really have that as often, right? Head and shoulders pattern or the inverse head and shoulder are basically your reversal patterns. There are two different types. When I say reversal, means that if it's an uptrend for head and shoulder, we are looking, if it starts to form and it breaks, then we'll look to short. Right, for inverse, its the price is going down, right, and once it reaches to the bottom and it starts forming an inverse head and shoulder, and once it breaks, that's where we enter along, right? So some key characteristics is that we can see that there is a neckline, right? The neckline is basically where we want price to break through first before we even enter about sell, right? So I'll show you some examples that I found on the trading view on poems. Right, so as you can see, on my left, there will be your inverse head and shoulder, and on the right, sorry, I've indicated wrongly. On my left is the inverse head and shoulder, and on the right is a head and shoulder. So as you can see, there's no need to be perfect, right? It can be a little slanted, but understanding that once price break the neckline, we want to take the entries, right? Okay, next up, right, it's a pendant. Right. So it is based to me personally, it's a triangle, but I guess people have a different take on this. Um, Pennant usually tends to be what you call most triangles, in my opinion, tend to be what you call the neutral pattern. But understanding where trend comes along is that we allow us to have a bit of a prediction, all right, to understand where price might move and where we want to position ourselves. Right, so as you can see on the images, right, we can see that usually there tends to be a big impulsive uptrend and then followed by a small little consolidation. And from there, once price breaks up, we will tend to enter long, right, or short, depending on whichever picture we're looking at. Or for the left one, we're taking longs. Okay. Normally the position or the target that we would like to exit in terms of the trade will be as long as the previous impulse. So that will be the target, right? Right, moving on. All right, so as you can see, it's pretty similar. Why I would say a pen is a triangle, right? Because the next time we're talking about will be triangles. All right, there's three different kinds. All right, the symmetrical triangle, ascending triangle, and descending triangle. All right, so let's go through the triangle first. All right, so this is basically our normal neutral triangle, where basically we don't really follow an existing trend. All right, we can see that there's really just two trend lines. All right, in the chart, if you really spot one, right, you just need two trend lines. All right, converging the lower highs and the higher lows. What this means is that, all right, the buyers are pushing it up and sellers are pushing it down. All right, there will be a point where one or the other will have to give way. Right, that's how I usually interpret it. Right, and once price breaks out from the triangle, right, and that's where we will have a decision on where to go, right, where to buy or where to sell. Right, moving on. Right, next up, right, is a ascending triangle. Well, in the name, it suggests really that for ascending triangle is more for uptrend. But there are times where I've seen in when I do charting that it actually breaks back down, right? So we can see that price we have a flat trend line as well, right? At the top, right, means that our highs are kind of neutral, kind of stopped at where they are. There's no more higher highs, right? But there is a aggressive buying power, right? The buyers are still there, pushing price in terms of the higher lows, narrowing up to the top. All right. So normally is we call it a bullish formation. So once it breaks, normally we will enter longs, right? So understanding where the trend comes from allows us to know that, okay, this is a ascending triangle, right? I want to take longs in there, right? I'll wait for the formation to break, right? Buyers take over, then I will enter long, right? But some rules that personally that I take would be usually not to enter immediately once it breaks. It's something that I will have to go through in the next webinar. It's basically usually for me there are some rules that I use which helps me like usually have a better price of entry. We call it retesting, right? So usually price once it breaks, I wait for it to come back down to enter. So it's more or less like a way to say buy low, sell high. Yeah. Right. Moving on. All right. So this one's to be the reverse of a ascending triangle. It's called a descending triangle, right? So same theory, right? We have flat lows, flat lower low, but we have lower highs, right? So as you can see for the triangles, all right, it is normally a bearish formation, but as I've said, most triangles, in my opinion, is quite neutral, right? As traders, it just gives us an indicative on where it might go, but it's not guaranteed, right? We still have to be patient. So some of the key things about pattern trading is that you don't really get to trade as often, right? Some of them usually form in higher time frames, right? So I'll run through a little bit on what time frames are later, right? So what we can see here is that we have sellers that are very aggressive, right, pushing price down, but buyers are still maintaining the lower lows, all right, at the flat line. And you can see on the image on the left, that is actually, you will say that, oh yeah, it's a bearish movement, but price broke back up, right? But on the right, that's usually the case where we have a perfect, like a descending triangle where price follows the same direction. There was a slight retest, and then from there, it just broke back down, all right? So it is a continuation, all right? But we still have to wait, all right? So next up, right, is flags, okay? There are two kinds of flags, a bull or bear flag, right? So from the two images seen, so how do we normally indicate what's a flag, right? So we need to have, do I really need to say that a straight buying pressure? Sometimes yes, sometimes no, really depend. But to make it perfect, of course, we would like to have one green line for usually the case for myself when it comes to flag trading, right? And on the right is a red line down. So that means the selling. We want to continue for sales. So we'll wait for price to consolidate. Right, you can see what a bullish flag is. So from here, you can still use two trend lines, but as found on TradingView, right? In poems, there is a tool called parallel channels, which you can use. From there, you'll be able to draw the flag pattern. Okay. This most of the case, people trade based on the breakout as well. But as you can see, there are some who actually take on the lowest or try to predict the retracement within the flag to make entries. Right. So that's a little bit riskier as you might get stopped out. Right. There are still instances where uh sometimes there are major news or let's say for example for stocks, right? There's a price earnings release. But for FX, let's say for US, there is like interest rate news from the Fed chair, right? Sometimes it will reverse. So entering a bit early usually tends to be a bit riskier. I would just usually just wait for price to break out, and then from there I make my entries, right? So these are a few examples that I pulled out from TradingView, right, for stocks. Right, this is for the Alibaba Group holding, right? As you can see, what I mean by why stocks is a bit harder to use is that there's a lot of gaps. And sometimes when the market open, it will just blast out from either direction, right? There's not really like what you call a following of like price action. So which is why normally when I practice on charting, I will use FX first, right? It will still apply to FX that there are times where it reverses, but well, for charting purposes to make it look nicer, in my opinion, to start practicing is really to use FX, right? Stocks is still applicable, definitely, right? And moving on, one of the next easiest pattern to recognize is a rectangle pattern, all right? So it's, to my opinion, is honestly a ranging uh market again. All right, still a consolidation. As we know, we went through about sideways market, right? But we can still use trend lines or even the parallel channel, all right, to highlight the sideways movement, right? So normally why they will highlight it as a rectangle pattern, because I guess for my personal experience is that these rectangle patterns are from usually lower time frames, right? Where price consolidate for a while and then it breaks back up, right? So we'll take a little pause here in terms of understanding the time frames, right? To understand that as traders, there are a few things that we must know, right? Personally, I've only met like three different kind of traders. Of course, there are many others, right? But people who normally trade, there are three types, right? There's your swing traders, your intraday traders, and your scalpers, or we call them scalp traders. Right. So understanding which kind of trader you are will help you significantly understand which time frame you want to look at. Okay. So personally, I am a swing trader or intraday trader. Right. I don't like to take too many trades per day because it's a lot of work. Plus, at the point in time when I started trading, I was in school. Right. So swing traders, we tend to use time frames that are called weekly, daily, 4 hour and hour, right? We usually take about 1 to 3 trades, right? And this setup usually take about a few days or so for it to happen, right? Then for intraday traders, all right, they use daily, 4 hours, 1 hour candles, 1 hour time frame, and 15 minutes time frame. Most people try to who enjoy actually a bit more of like the exciting kind of trading, then they will choose like scalping because you take more than like 5 trades a day. All right. It's but all small trades. So they're talking about short-term price like spikes and movements, you capture it. So the time frame tend to be a bit smaller, all right? They use 30 minutes, 15 minutes, 5 minutes, and 1 minute. So why we have these four different time frames, right? Because if you look at a chart, most of the time there's a lot of candles, right? So having different time frames allow us to remove the noise, as we call it. By removing the noise, we get a clear picture of the market direction. First of all, like for me, as a swing trader or intraday, right? If I were to try to find a direction of the market on a long term basis, then using a 4 hour, right, I don't really get to see much because there's a lot of candles going on. But once I zoom out, means that I go into weekly, it allows me to see on a broader picture picture, right, of the market in general, so I don't trade against trend. Then from there, I use my daily candles and all, daily candles, all right, daily chart time frame, all right, to determine areas of interest, all right. And from there, my 4 hour and a 1 hour will be where I want to make my entries, right? Okay. Moving on. Right, these are some examples that I found. All right, you can take a look. All right, basically this is on a hourly time frame. All right, price consolidated for a while, breakout, and then from there it continued. All right, okay, quite simple for rectangle pattern. This is a short-term ranging market. All right, right. This would get a little bit harder to chart. I mean, harder to find. In my opinion, because they are hard to kind of like what you call it, visualize, right? But the idea is that I look at it as our door stopper, right? To stop the door from closing, right? A wedge, right? So they are both continuation patterns, right? To understand that, right? So we want to understand when we have a rising wedge or falling wedge, uh, the price action is narrowing, right? And for the downtrend, all right, it will be a rising wedge, and for uptrend, it will be a falling wedge. All right, so on the left, there will be your rising wedge, and on your right, there will be a falling wedge. Okay, so price is going down on the downtrend, right, and then it starts to retest and start to consolidate, or we call it uh bounce around in between these two trend lines that are converging, right? And at the top, it starts to narrow, right? So when it starts to narrow, most of the time, some traders are a bit riskier. All right, when they reach to the narrow point, they actually submit like limit orders for price to reach there, and then from there it will just enter immediately. All right. Of course, there is cases where, as I said, it reverses on them. Okay. But we still want to keep it a little bit safe to stay in the market. All right. So we want to wait for price to break out. All right. Next up. Right, here are some examples, right? Really that I found it. There's actually live about 2 weeks ago that I've been charting, right? Yeah, it's odd yen and odd cat. You know, odd yen, correct? And one is USD yen. Yeah, if I remember correctly. Yeah. So, one of the key things that other than just learning about how to trade with patterns and understanding trend, is that we must stay long in the game to practice. And a lot of times, I've seen people with positions that don't have stop losses and everything, or don't understand managing risk in trading. All right, so to understand what leverage or what risk management is when it comes to trading with CFD, is that we have to look at the example that let's say we're trading stocks, right? For this case, for this example, all right, we assume that ABC stock is $1 per share, okay, and we decide to purchase 1,000 shares worth, right? So we understand that for stocks we do own the underlying, okay, and the initial outlay is a bit higher, right? And assume that we bought it, and if price were to go up to $1.05, right, we profit $50. All right, there's a 5% increase in base capital, right? But if it falls to 95 cents, then same thing, we'll lose $50, but it will be a 5% loss based on initial capital, right? So now comes to leverage trading, right? So CFD. So it is a double-edged sword, right? With leverage, we get to hold on to bigger positions with a smaller amount of margin required, right? And understand that the initial outlay, that means that it will be smaller, but the losses can be magnified. So let's go through some examples, right? So let's give example of what 10% margin requirement, right? So we have a 10 times leverage. All right, so we only need $100 to hold $1,000, 1,000 shares worth, right? That's the initial capital outlay, right? If price were to go up, we will make 50% increase based on capital, which is high, right? But if it falls by 5 cents, so same theory, we lose $50. We lose 50% of our initial capital, right? So that's the difference. So you can understand that based on our capital outlay, we do take a significant hit, right? And sometimes when we over leverage in terms of trading, the over leveraging causes us to lose even more, right? So we understand that about position sizing next, which is also part of basic risk management, right? So here we'll show an example, right? That based on one of the counters that we have, right, which is a DBS, for a risk management based on a $10,000 account, right? So normally as traders, we would want to risk 1 to 3% of our account size when it comes to trading, right? Uh, why 1% or 3%? All right. So if it's a 1% risk based on the normal simple math, all right, in one day, all right, you take 100 wrong trades for me to quite bust my account, which means that I go to zero. All right, for 3% risk, all right, it will take me 33 trades, 33.33 trades, right, to bust my account. So this 1% risk to 3% risk, it allows us to have uh room for error. But of course, we want to reduce it, but trading is a bit tricky, right? So even then, we also still must apply basic risk management, right? So with a 1% risk, which is about $100 losses in for a 10K account, right? For DBS, we want to buy 100 shares of DBS, right, at 46.20, right? So if DBS were to fall by $1, right, it would mean that it will hit our target risk of 1%, right? But if I'm willing to risk 3%, right, then DBS will fall by $3, right? So, but this is me this is understanding that for position sizing, right? So for the next example, it will be the same thing, but what if we take on a bigger position, right? I mean, with leveraging, we can take on a bigger position, but the 1 to 3% risk will change, right? So if I were to have like double the shares, right, for DBS, right, 1% risk means that change of 50 cents compared to the previous one, which is a dollar, right? Reduce it by half, then we will meet our 1% target risk, right? And a change of 150 will hit our 3% risk, right? So uh understanding the size of our account is one, but also understanding the contract size or the amount of contracts we purchase also is, on the other hand, a bit more important, right? And to take it as a reference to how much risk we're taking on, right? Right. So we want to reduce the issue of over trading, which can lead to over losses, right? Every time we take a trade. Right. Moving on. Okay, so another form of basic risk management, all right, is to take multiple take profits, as we call it when it comes to trading. All right. So for this one, this will be, I think, New Zealand yen. All right. The To understand what I mean by multiple take profits, right? It will be for this one, if let's say I have only one take profit, we call it TP1, right? A basic TP at 83.51, 83.51. My entry is at 85.52, right? And I let the trade run. So I'm not managing actively. I just let it run. I set the stop loss and take profit. All right. And if let's say it reverses, then of course I'll lose the trade. But to understand trading, we usually want to take profit first so that we can get a risk-free trade. So what I mean by risk-free trade, of course, we have to be in the money first. So the next one you'll see is that it's the same trade, right? We can kind of understand that if price were to reverse, you can see that I have set drawn two take profit lines, right? So first of all, it's my first take profit, right? Usually for me, I will use 50% of my target. So from the whole entire take profit line, I will use 50% mark as my first take profit. Some traders do use 25%, right? But after they do take profit, all right, what they do is that they push the stop loss to slightly past our below our entry price. So if any point in time, like you can see, like if I were to panic, right, and I close the trade a bit earlier, or let's say price were to just go a little bit higher and touch my stop loss, right, I will pay nothing, right, because I've already taken my first set of profits, right? So realize the profit, right, because it's all unrealized, right, at the end of the day until we close the position. So by taking the profit earlier, as a closing our positions in smaller amounts, right, we are able to take in more money as well. That's the first one, to secure our profits, right? That's the most of it, right? Then from there, we was usually set after that, as I repeat myself, to set the stop loss back to pass slightly our entry, right? So anything else, If the trade were to reverse, I will not feel that I'm at a loss because I've already made the realized profit, right? The remaining I'll usually let it run, right, all the way to my final take profit, right? Right. So um next up, right, we have the mindset, right? Some things that I still use to today, all right, is the mindset for trading, right? So logic over emotions, right? We for there are times when I started trading, right, where I actually make over losses when I first started as a when I was in uni. Okay, and you want to keep making back, right? But you get a bit panicky and you make mistakes and you overtrade and you lose more than what you plan to do, right? So we have to understand that once we make the 1 to 3% loss on our account, we just take a step back, right? Go and take the day off, go and walk around, don't don't get too affected by it, right? Then redo your whole entire thing, right? Redo the entire process of charting and planning your trades, right? Of course, then it comes down to the second point, which is to stick to your plan, right? And trade your plan, right? Once you have set rules or even plan your trade already, right? You just want to wait, right? If price breaks out or price moves in a direction that is really predicted, but it didn't come back to where you plan to enter, just move on, right? There are plenty of trades. The market doesn't stop. Okay. Next one would be don't get too engrossed. All right. I think when I started trading, I got too engrossed with charting, and I think I spent almost 10 hours just sitting in my room just looking at the charts, trying to find entries. But the more you look at it, the more you actually don't see it. Right. It's kind of a funny thing, but yeah. That's what happened to me. Right. Most of the time, I would take one day to plan or even look at the charts. If there's nothing, then normally I don't hop on it, right? There's nothing to trade, then I won't trade, right? But for now, of course, I do practice it quite often. That I think it's a bit more of like a repetitive work for me now, right? But for from the beginning, right, you'll get a bit frustrating. Okay, right? If your trade is wrong, all right, the next point is just to really just accept it, right? There's no need to be angry, right? Most of the times, we get irritated, right? If it's wrong, it's back to the drawing board, right? And lastly, is don't FOMO, right? Nothing to fear out, don't be fear of missing out. There's nothing wrong with just waiting, right? Okay, right. I think come to the end of my sharing, right? So there is what's it called? We have a promotion coming up from now April all the way to June. All right. When you make your first CFD trade, all right, you'll be $100 credited to you, and then $10 for every trade after. So you can make up to a bonus of $500 or more. All right. Okay. We'll now be coming to an end. All right. I'll be taking questions if you have any. All right. Let's do a Q&A. Okay, so the first one is, can US stocks be traded using CFDs? Yes. So we do offer US stocks on our CFDs, right? So next one will be, does pennant mean there's a 50% chance it goes up, 50% chance it's down? Yes, most of the time, I mean, from understanding applying using trend, right? Most of the time it would lean towards where the trend is going. So for the pendant, right, if it's an uptrend and it starts to form, right, we will usually tend to have a higher chance to follow the same direction, which is an uptrend. So, uh, years of looking at it, I would say is more of a 70% chance that you will follow the existing trend, right? Can you hear me answering? Next up, for intraday trading using 1 hour time frame, how do we trade during the first hour of trading? You're talking about trading on You're talking about trading on what's it called? US stock market, or you're trading on what time? FX. What's the underlying, right? How do we differentiate wedges and triangles? All right, so wedges and triangles. From the three examples, right, the rising wedge and falling wedge, all right, it's one will be longer than the other, and it will converge for the wedge. For triangles, right, there is the ascending and descending, right? So normally, that would just be the flat line at the top, right? You can see like we have a 90 degree, most triangles at 90 degree, except for the what's it called? Neutral triangle, the first one, right, which is similar to a pendant, right? So wedges, we will tend to look at a narrowing top, right? It goes upwards, right? Right. What is the commission for holding overnight? Depending on the market that you're trading, if you're, okay, let me share. It depends on the market you're trading, but for like equities, there, let's say Singapore, okay, it will be long finance charges overnight will be per annum lah. This on the per annum is 6.75%, right? Then for shorting, it will be 3%. Okay. You can find it on our PhillipCFD.com, all right, the pricing, all right, to understand better. Yep. For losing trade, does Poems automatically close your position? Because what if the amount goes more than capital inside Poems? Right, so for Poems, it's a little bit trickier then, because usually for MT5 it's easy, we can just set the stop loss and carry on. But for Poems, what you should do is that once you enter a trade, you should, because it's based on a first in first out basis, right? You can use the multiple different order types in Poems to help you exit, right? So one of them is OCO, one cancel the other. The other one is that you can submit just another, let's say I trade SQ, SIA, and it goes up. But if it reaches to a certain price, I can submit a sell order. So I'll submit the sell, let's say I buy 10 SIA, right? I'll submit a sell limit order, but at a lower price, right? So that's technically my stop loss. So once it hits that certain price level, then the limit order will trigger and I sell the 10 that I hold, right? Referring to SGX intraday trading. For referring to SGX intraday trading, so you're talking about 1 hour time frame. How do we trade? Okay, so normally once the market closes, is a good time to take a look at how it ended. All right. So with SGX, you want to use one of the liquid counters, right? Most of the time, I would suggest trade like DBS or UOB. It has a little bit more movement. That's the first one. 1 hour time frame, right? The first hour of trading. So if let's say the day before or 2 days before, the price has consolidated or you have identified something. So we will actually find price levels where I've taken interest on. So let's say it's on a downtrend. Right, it has moved down. Let's say, for example, imaginary price is at 45. All right. And then the next 2 days it went down to 42, 40. All right. So every time when the market close, I will identify points where I can actually enter again. So like support resistance trading, right? So I look for key levels where I think price might go back, right? So one of the tools that you can use when it's a 1 hour trading time frame is the Fibonacci retracement. So when it's usually a 1 hour time frame, you can trace the downtrend for this case, and then you look for the magic zone, we call it, the golden zone, which is the 50% and 61.8%. You can set a sell limit at that point, and then your stop loss would be at the 71.8 level, right? So trading with the 1 hour time frame. So normally that's what I would do lah, right? For intraday 1 hour time frame, right? Hopefully that answers the question. Other than that, you can go use a 1 hour time frame to find the general direction, and then you use a minute, so 15 minutes and 30 minutes to look for areas that it will retrace in the short term, and then from there you enter within the day lah, right? What about commission for equity trade for SGX and US market? Right. So for Singapore CFD, right, the commission is at 0.128%. Right. There is a minimum commission of $25. Okay. Then for the US market, the minimum commission is 15 US, right? Is the commission rate is at 4.18%. Right. Okay. Next question is, for long position, is there a scenario where stop loss was set in poems but it didn't execute even though went below stop loss? Scared even though. All right, so there are times when, let's say for example, there is a high volume, or like, for recent days, for the past week, there is the Liberation Day, or like Trump way of like manipulating the market, right? So there's a sudden sell off. So if let's say your stop loss is sadly past a certain threshold and the market gaps towards that price, then of course it will miss your stop loss and it goes further lah. So sometimes you want to set it slightly past. I think the limit you try to set is about 20% of the price of the stock. Yeah, try to set around there. Right. If usually when you put 20% of the price, then you can go a bit higher. I think because the it's not like exact, but you can use the 20% as like the benchmark. Yeah. Anything else? Any more questions? Right. I think if there's no more questions, I'll hand it over to my colleague. Right. Soon. All right. I'll give you another 5 minutes. Oh wait. Please advise about 4 hour trading. So it's linked to almost intraday trading lah. All right, for this case. Do you trade just using the 4 hour window, or what's the current time frame you're using? Just 4 hours? Right, and is it for stocks, or what is it that you're trading now? So I can have better understanding. Any specific indicators that I use currently? One of the easiest one would be the what's it called? EMA crossing. Right, it's just really to help you see trend, but it's a lagging indicator. Right. One of the trading strategies that I'm currently trying to learn now is the EMA cross. Right. So when the shorter EMA time frame crosses the higher time frame, right, be it crossing up or down, then that will indicate a buy or sell. Yeah, it's a bit of a simpler trading strategy that people are using nowadays. Right. Right. 1 day 4 hour time frame for stocks and go. Okay. So this is all your 1 day and 4 hour time frame for stocks. Okay, for stocks, I think there's a shorter window. So I will use a daily to really just find to identify like the current direction. All right. 4 hour time frame. Honestly, is for me to narrow in. All right. And then from there, I find areas like, let's say for example, currently what I'm using. for trading. All right. To identify patterns. All right. You can find patterns on daily or 4 hour. All right. And also I mix a few other trading strategies inside as well. So I use supply and demand. So with the 4 hour time frame, I can find like the short term supply and demand zones where let's say it's a continuation of like a downtrend. All right. Then I use the 4 hour. I identify some zones where there's like a big impulsive move. All right. Because we are Indian retail traders. All right. So big movement tend to be from financial institutions. All right. So we find these zones within the 4 hour. So for those who want to, you can also just you call them as like support resistance level. Right. So you find like where price tend to bounce a lot off from. Right. Then with the 4 hour time frame, I find those zones. Then I use 1 hour to find the entry. Right. So to find entry, normally then you have to know how to read candles. Right. So when the price goes back up to that 4 hour zone that I've highlighted, then most of the time I will wait for like a rejection of the level, and then I'll take either a short or a long. Right. And for stocks and also gold, right, it's the same theory, right, for trading. Right. We can apply it pattern as well and apply support and resistance when it comes to these two. Right. But for stocks, you have to understand that there's only a very short window where you can trade. Right. So I would tend for stock traders, I will usually just say use the 1 hour, all right, or 30 minutes. Okay. For gold, for me personally, I've been using daily as well and 4 hour, but I still use the 1 hour for my entries. Right, I stick to my routes, which is to do intraday trading. Sorry, swing trading. Right. Uh, I'll use my 4 hours to really just find the support resistance zones. Right. And then I'll wait. Right. And then use my 1 hour for entry. Right. Same move for both. Right. Right. So with that, I think thank you for your time, everyone. Um, I think with the presentation today, thank you for everyone. Right. Thank you for your time. Right. Hand over to Shermin. Thank you.